Do you need me to be center?
No,
Can I roam around a little bit?
I can follow you, so.
Okay, great. Yeah, please take some materials. Thanks for having me tonight, guys. And hopefully I can really customize this a little bit more for anybody's specific needs. My specific speaking style, just interrupt, ask questions along the way. It doesn't need to be formal at all, or you can save your questions at the end. That's fine.
Oh, well, before you begin, why don't we introduce ourselves to you?
Oh, yeah, I'm
Yeah,
sorry.
that'd be helpful.
Forgot with the holidays. Well, these guys are familiar with the group, but we usually do like a quickie round robin.
Okay.
So we'll start with you.
I'm Jeff. I'm a web developer, and I help you guys get online. So.
And CAD and design, right?
Mm-hmm.
I'm Roger, patent attorney. So I'll handle your legal questions on patent, trademark, and copyright.
Yes. Good evening.
My name is Bob Williams. I'm on a company called Colorado Wholesale Group. We make applicators and squeegees and such. Manufacturing here in the Golden area.
My name's Steve Daves, and currently working on some mosquito stuff as well as other things.
Did you say mosquito stuff?
Yeah. Control.
Okay. Great.
New stuff. Very new.
Introductions?
Yeah.
Hey,
Yeah,
Christian
you're
Gerbil, second meeting, and what else what are we looking at there? Why are we here?
Yeah.
Why am I here?
Sure.
Yeah, just what's new with you since the last meeting?
Since the last meeting, nothing new in this aspect, unfortunately, but
Okay.
I'll keep inch by inch pushing. I've got ideas and stuff, but I want to network and talk to people and brainstorm and make connections so I can figure how to get my ideas moving forward. That's why I'm here.
I've got a PowerPoint presentation. It's in the right side of the handout there. You can follow along. Just a quick self-introduction here. I've been in the CPA world for about 20 years now. First 10 years were spent at a small local firm working on taxes and business valuations. And then the last 10 years I've been doing nothing but business valuation and litigation support type of work in a pretty wide variety of industries. I've worked with startups, I've valued intangible property, intellectual property, and kind of everything in between. And then just a real quick plug here for the firm. We're a full service CPA firm. We do provide audit, tax, valuation, litigation support, investment advisory, and temporary and permanent financial and accounting staffing.
You do about the same kind of work Mark Pedago does for litigation?
We do similar work. Mark's got a definite expertise or niche area in the IP world. So he works a lot on patent infringement, trademark infringement type of cases, as well as general commercial damages cases where one business is suing another over something like breach of contract. He's definitely the IP expert. So I have 3 topics to really discuss today: entity structuring, tax issues, and then valuation issues. So the first issue, entity structuring. A common question that we get from clients is how should they set up a business that they're starting. They've got an idea, they want to monetize that idea or develop that idea. So how do they actually formalize and get a business started? And it can be a difficult question. There's a lot of issues to consider that I'll go over, but really getting a professional advisor involved early in that process, CPA and attorney are particularly important to help you get the right type of entity formed for what you're trying to do. So you're going to have filing and compliance issues, and you're going to have certainly tax issues to consider as well. So the various tax and non-tax issues to consider. Number 1, ownership and continuity changes. If you die, what happens to your business? how are you going to be able to expand and add additional capital to your business with new owners. Legal liability protection is a huge issue, especially when you're just starting out and you're concerned about protecting your personal assets. Federal and state income taxes, certainly a very big issue, as well as Social Security taxes. Other factors like being able to raise capital in the future from outside investors should also be a big concern as well. One caveat, I'm not an attorney, I'm a CPA. Roger is going to be your man for those types of legal questions. I'll also defer those questions to Roger, but certainly it's really important to get an attorney involved in this process. So we have 4 basic types of entity structures to consider. First, we have a sole proprietorship. Then we have partnerships, both general and limited. Corporations, a few types of corporations to consider, and then a limited liability company, and then depending on your jurisdiction, there's a few little variations there with limited liability, limited partnerships, and limited liability partnerships, and a few other little variations. But these 4 types pretty well cover the spectrum of at least here in Colorado, of what to consider. So first, these sole proprietorships, these are really just a one-person business. It's very simple. There's not a lot of formality in the way of getting these started. You don't have to, you're generally not going to have to do a lot in the way of registration with the state or formal, prepare any kind of formal incorporation documents that you would expect with another type of entity. You may have to deal with some type of a license or a permit with the state, but it's really pretty minimal as far as that red tape is concerned. Now, an owner is personally liable with a sole proprietorship. There's no type of corporate protection. So if your product, if your business gets sued, your personal assets are potentially in jeopardy. But on the flip side, it's also very simple for tax purposes. It's easy to set up. But then again, if you die, the business is pretty well kaput. So to summarize, the advantages are it's very simple, and the weaknesses are you have really zero personal liability. Now, partnership, generally a relationship between 2 or more people. It's not classified as a corporation, but you typically want to have, I would say you always want to have what's known as a partnership agreement to formalize the actual entity, spell out how the entity is going to be formed, who is responsible, which of the partners are responsible for which type of activities, how much money they have to contribute, how the income and losses are going to be split, and then how the entity can be dissolved, and how new partners can be admitted. There's a bunch of concerns there that, again, the attorney can really help, or really is necessary to get this agreement written up. You know, you hear a lot these days about online options for going out on the internet and incorporating for $50, filling out your own forms. That's great, but the money that you spend, you're kind of the old adage, you get what you pay for, definitely applies with that. And spending the money to have an attorney properly draw up one of these agreements is something I can't emphasize enough. In my litigation support world, I see disputes very frequently coming back to these agreements and how the agreements were written and what the real intent was. And if you've got a real amateurish, self-done type of agreement, you're really opening up potential trouble in the future, as opposed to going to an attorney and getting it done right, the right way the first time. 2 types of partnerships. There's a general partnership. All partners are going to be fully responsible for the partnership liabilities. And then you have a limited partnership where you're going to have one general partner who's on the hook personally. The other partners are going to be limited partners who are only liable to the extent of their investment in the partnership. And then another thing to consider with partnerships, and quite frankly with all these entities, are buy-sell agreements. And a buy-sell agreement, it can be either included within the partnership agreement or it can be a separate document. But it's something it addresses how in the future one partner can buy out the other partner, what type of events trigger a buyout. Say one partner is incapacitated, one partner dies. Maybe you want to set an age where one partner needs to retire. You can get that all carved out or memorialized in a buy-sell agreement. And again, these buy-sell agreements need to be properly drafted by an attorney because that's a very frequent area of litigation. You don't want to have to hire me 10 years down the road, pay me my expensive rates to try and litigate a matter that could have been avoided had a agreement properly been crafted in the first place. Corporations are completely separate entities. They're separate from the owners and their managers. So a corporation itself is independently liable and legal for wrongful actions. But on the plus side, the owner's personal assets are protected as long as you are reasonably operating that corporation and are properly, I guess, keeping books and records and abiding by the articles of incorporation. Corporation is generally not going to be limited by the number of shareholders in what's known as a C corporation, and that's certainly a consideration if you're looking to raise funds in the future from investors, and you expect to have quite a few investors as potentials out there. A C corporation is not going to have that type of limitation, and again, you want to consider the buy-sell agreements for those corporations to handle those future events of the owners needing to sell.
So that can be public or private, right?
The corporation?
Yeah, the C corp.
Yes. Yeah. I mean, typically, unless I guess by default you're gonna be a private entity, you'll file articles of incorporation with the Secretary of State that'll be visible to the public, but as far as the limitation on the number of owners.
So you only, like a C corp that's public has to do a public tax return and that, what do they call it,
10Ks, yeah, yep.
and all that, so their financials are all public info.
That's open book, yep.
So if I'm a private corporation, I don't have to do that, right?
Correct, correct, yeah, your
That's
financial.
why a lot of people like that, right?
Yeah,
Okay.
yep, absolutely. So with small corporations, I mentioned before that individual owners of a corporation are not personally liable, but at the same time, especially if you're a startup, you don't have any kind of a track record trying to get financing from a bank, well, they're going to be asking for personal guarantees. So regardless of what type of entity you're forming, that in mind, that legal protection is all fine and dandy, but for a bank to really lend you funds, you're going to have to personally sign on that dotted line.
Do you, just from your perspective, at what point is a company able to borrow against the company's assets? Is there a certain size, or when do banks loan against the company as opposed to requiring personal guarantees or outside collateral?
I think that the best answer to that is they've got to have a really strong track record of earnings and profits.
So a number of years of making money and
Yep. Yep. A startup entity probably has very little chance of getting any kind of funds without personally guaranteeing, or at least putting up some type of huge collateral with the bank. So a C corporation is actually taxed at the corporate level, and I'll get to those taxes in just a moment. And I want to close on this with what's known as an S corporation. I don't know if you've heard of an S corporation. It's really just a tax distinction that allows the corporation to be what's known as a flow-through entity. So the entity itself won't pay taxes, but the tax liability or the taxable income of that entity flows through to the various owners, and then you would pay the taxes at the individual level. We have a limited liability company, usually known as LLCs. These are pretty popular. They're taxed just like a partnership, but they provide liability protection to the members, similar to a corporation. So only the LLC's assets are actually at risk, and again, it's a pass-through entity. So the entity itself does not pay income taxes. The owners pay the taxes on the taxable income. An LLC has what's known as an operating agreement, similar to a partnership agreement for a partnership, or articles and bylaws for a corporation. Determines how income is allocated among the members. So the nice thing about an LLC is it allows you to have a lot of flexibility with how to allocate the income or provide distributions to the various members. Certainly with an S corporation, you're really restricted to allocating income and distributions based on ownership percentages, whereas with a LLC, you're able to really customize that and say I may be a 10% owner, but the LLC agreement may provide for me to receive 1% of the profits and 1% of the distributions, because all I did at the beginning was put up some of the funds, for example. So it's great in the context that allows a lot more flexibility than an S corporation. And then again, you want to consider the buy-sell agreements, and you've got a Form 1065 to file with the IRS to report that income. So the basic tax considerations to think about here. So partnerships, S corporations, and public and professional service corporations, you've got some flexibility there with choosing a taxable year end. With those, I think the common solution is really just to choose a calendar year end. A sole proprietorship, as I mentioned before, is taxed to the owner itself, but it's very simple from a tax return perspective in that you just prepare a Schedule C on your 1040. There's no separate tax return filing requirement. So that's a plus for a sole proprietorship. Partnership files its own tax return, and then it has its income passed through to the owners. Same thing with an S corporation. But a C corporation is very different. C corporation can have two levels of taxation. So the entity itself pays taxes, and then to the extent the entity pays distributions or dividends to the owners, those dividends are then going to be taxable to the owners as well. So it's two levels of taxation. So C corporation, from a tax perspective, you have to be very careful in your planning to avoid paying Uncle Sam more than your fair share. And some other tax considerations, wage income versus self-employment income. When you're a sole proprietorship, or whether you're an owner of a partnership or a LLC, the income that flows through to you is taxable as self-employment income. And when income is taxable as self-employment income, you have 12+% self-employment taxes to pay on that income, very similar to the Social Security and Medicare wages taxes that are withheld from your paycheck. Uncle Sam gets his cut through the self-employment tax. So sole proprietors, you may end up paying yourself wages, and then when you pay yourself wages, then you're paying Social Security and FICA taxes through those instead of paying the self-employment tax. And then with the new Affordable Care Act, there's a whole slew of healthcare considerations to think about.
Are they pretty even on the tax deductions for wage versus self-employment, or do you recommend one over the other?
Yeah, that's a good question. Here's what frequently happens. If you're really trying to minimize taxes, what I usually see is people will have, if they want to go with a corporation, they'll form an S corporation, and then they'll pay themselves kind of a minimal amount of wages from that S corporation. So those wages will be subject, just like any wages, those wages will have Social Security and Medicare taxes taken out, but the rest of the income at that S corporation is not subject to self-employment tax. So you typically see an owner of an S corporation trying to pay themselves a minimal salary, so they have minimal payments of the Social Security and Medicare tax, and then the rest of the income is not subject to self-employment tax. But you don't have that option with a partnership or an LLC.
Going to like retained earnings, like a C corp.
Yeah, I mean a C corporation.
Or it's just a company bank account, I guess.
Yeah,
Okay.
yeah. But of course, the IRS is onto that, and they look at S corporations and they say, "Boy, you, Mr. Owner, you better be paying yourself a fair salary, otherwise we're going to impute
Oh,
a fair
so
salary
they
on you."
say, yeah, you can't pay yourself less than minimum wage.
Yeah, exactly. And then you have the opposite problem for a C corporation, where a C corporation, you'll be tempted to pay yourself as an owner too much by the corporation because of that double taxation issue. If you're paying yourself salary from the C corporation, that income's only going to get taxed once. So again, the IRS looks to that and they say, Mr. C corporation owner, you're paying yourself $300,000 and you're not even active in the business. Why are you entitled to that salary?
What about dividends? Is there a difference between C's to S's?
Absolutely. So an S corporation can generally make distributions on a tax-free basis, whereas a C corporation, the dividends are always going to be taxable to that owner.
They're after tax.
They're after
Dividends.
corporate level tax, and then you pay as an individual, if your C corporation is paying you dividends, you're paying individual income tax on those dividends. So that's what you really want to avoid, is a situation like that. That's why a C corporation can be really detrimental from a income tax perspective. So any questions on entity selection or taxes for?
If you, let's say you can stay private, why would you want to be a C corp?
Probably the best answer to that is that
Oh,
you need to have
maybe investors want different
investors,
classes.
because
Okay.
with an S corporation, I think the limitation is 75.
And one class.
Yeah, in one class of shares. Yep, exactly. So if you're looking to raise a bunch of money from a bunch of different people, then maybe the C corporation route is the way to go.
What if you want to switch from a C to an S? What do you have to do?
File a simple one-page form with the IRS. It's very easy. Going back is a whole nother story. But it's a very easy election to make. I mean, it's really just an election. The IRS is not going to. I've never heard of an S election being denied. It was timely filed. So I would say the majority of corporations that I see are going to be S corporations.
One question, your company, PC.
Yes.
So that's another, is that professional corporation?
Yes.
So what's, I mean, you see guys in your space, they could be LLPs,
Right.
but some are PCs.
Yes. Probably going back to, we were formed so long ago that I don't think LLCs even existed
Right,
when
they
we
are
were,
the newest
when we
one.
were formed.
Or LLPs. Or,
Yeah, LLPs weren't around either when we were formed.
So a PC, professional corporation, doesn't do stock or anything. That's just a separate business entity for liability purposes.
Well, I mean, it does issue stock technically, but it's not something, you can't issue stock to the general public without
It's
running.
just inside.
Yeah, it's all inside. Yep. So a couple valuation issues to consider. That's kind of my bread and butter, what excites me. That's my passion. So a couple things I'll go over here, all within the context of trying to help you kind of plant some seeds here, thinking about how valuation is going to hopefully affect you and your ideas down the road. It's really never too early to start thinking about those. So this first thing, just going over kind of why a business valuation is needed. A whole slew of reasons. I work a lot in gift and estate planning matters, reporting valuations to the IRS. Hopefully in your cases, you need valuations because you're trying to sell your idea, sell your company upstream, or you're trying to raise some capital in the way of equity investors. But there's quite a few reasons for why business valuations are needed and who needs them. We do a lot of work providing them to attorneys and in the context of litigation, so courts and judges are going to be looking at our work pretty frequently. So what do we consider when we're trying to value a business? We need to think about the type of entity, the purpose of the valuation, a valuation date. We've got standards of value, a level of value, premise of value, which I'll get into here in a moment. You think about the nature of the business, the economic conditions, the book value of the company, the earnings capacity of the company, dividend paying capacity, other market factors. So the standard of value answers the question, value to whom? So you may have heard the term fair market value, which is probably the most common standard of value. There's also investment value, intrinsic value, and fair value under state standards or state statutes and financial reporting. So fair market value, I've got the definition written out here. So it's the price at which property or service would change hands between a willing buyer and a willing seller, neither being under compulsion to buy or sell and both having reasonable knowledge of the relevant facts. This is a very hypothetical definition. It does not involve a specific buyer or specific seller. It's really just a hypothetical amount that we deal with in the tax world all the time. Now you contrast that with investment value. Investment value is the value to a specific buyer. It's going to consider synergies. So investment value is typically going to be higher. So in the context of a startup or a technology company or a company with a great idea, ideally as a business owner, you would try and you want to be able to sell your entity for investment value, and that value to that specific owner who's able to really benefit from your idea more than someone who is not in that industry. So for example, if I've got a great mobile technology idea that would be applicable to smartphones, well, a smartphone manufacturer or smartphone developer or designer is going to have a lot of synergy from my idea, and they're going to be willing to pay a lot more for my idea than someone else who's not in that particular that line of work. And as another example, you see a lot of roll-up in certain industries. The airline industry, you have one airline buying another, well, there's a lot of synergy there. They're able to gain a lot of economies of scale. They are able to avoid duplication of executives and that sort of thing. So investment value is really your goal as a business owner or an idea developer. Intrinsic value, I'm not going to spend really much time on that. It's just really for a public company, or for example, it would be me saying, well, I think AT&T is worth something different than what the market is actually saying it's worth. And then fair value, this is under the legal standard of value specified by state statutes, and it's usually used in dissenting shareholder matters. So some of the nuts and bolts of business valuation, how do we actually put numbers to the value or estimating the value of a business? Well, we've got three different approaches. We have an income approach, market approach, and an asset approach. That asset approach is sometimes known as the cost approach. And then under these different approaches, there's a couple different methods that we use. And ideally, in a perfect world, we'd be able to use at least two of those methods or two of those approaches in valuing the business. And we, again, in a perfect world, those numbers would, the income approach and the market approach would come in a very similar number, but in reality, we have a lot of work to do to try and reconcile those differences between the different approaches and methods, which is one of the things that makes my job so interesting.
Would market connotate comparables you have to
Exactly.
similar businesses?
Yep. I'll get to that
Okay.
right next here. So really the asset approach is the most simple approach to understand. It's based on this principle of substitution. So what would a buyer pay for a similar asset of equivalent utility? And it's often the primary approach if the business has losses or does not have really significant projected cash flow, or is very asset intensive. And it can be used for both control and minority level valuations, control being generally greater than a 51% ownership interest, and minority valuation, someone with less than 50% interest or less than 51% interest. So we typically use something known as the net asset value method, and it's just really looking at the balance sheet of the entity, saying, okay, here's the value of all the assets, and subtracting the value of the liabilities, and that's your net asset value. But for technological based companies or companies with a lot of intellectual property or intellectual assets, the value may be indicated under this method may be completely worthless. I mean, if I'm Bill Gates and 20 years ago and I spent $1,000 and developed Microsoft in my garage, and I knew that I was going to be having a significant likelihood of future profitability, and I was able to estimate that profitability, that $1,000 that I spent that's on my balance sheet, that's my net asset value, is completely meaningless. But you have to look at that from the other side too. If I spent $1 million developing an amazing fly swatter that nobody in their right mind is interested in buying, is my value really $1 million? Probably not. So the market approach, also based on the principle of substitution, and it can still be used for both control and minority level valuations. As Roger mentioned, we use what are known as comparables. So we use two different methods: a guideline public company method, where we try and find public companies out there in the marketplace that are actively traded on the public exchanges, and we're able to derive valuation multiples from those. So for example, if I'm able to find a good public company similar to your company, and that public company is trading for 2 times its revenues, I can extrapolate that value to your company. Say if your revenues are X, 2 times X is a indicated value of your company, subject of course to quite a few adjustments on my end, because public companies have significantly less risk than a smaller private company. And then we also use what's known as a guideline transaction method. This is somewhat similar to what you might see out there in the real estate appraisal world. If you've had a home appraised, you'll see that the appraiser looked around the neighborhood, found 4 houses that were somewhat similar to yours that sold for various amounts, and they're able to ascribe a value per square foot, and they can take that square foot value and multiply it by your square feet in your house and figure out your value. Same thing with this guideline transaction method. We've got various databases out there where we know of businesses being transacted at certain multiples, again looking at revenues and earnings and cash flow, and then trying to superimpose those on your business. And then the income approach, which is really most applicable to startup companies and intellectual property. So value is based on the present value of expected future benefits to be derived from ownership. So we're either discounting or capitalizing cash flows for operating companies. And again, this is applicable to both control and minority level valuations. You may have heard what's known as a discounted cash flow method. This methodology attempts to estimate future cash flows beyond your valuation date. So we're here at the end. If I'm trying to value a company as of December 31st, 2013, we're going to estimate 2014, 15, 16, 17 cash flows, and then discount those back to present value as of our valuation date to try and estimate that current value. And then we also use a capitalized benefits method. This is used for more stable companies that are already in existence. Yeah.
I'm sorry, you lost me on that discounted cash flow. Can you
Sure.
go over that a little bit more?
Sure. So for discounted cash flows, we're estimating future cash flows of the business. And we'll use this typically for a company that's in startup mode, growth mode, or where future operations are expected to be different.
Yeah, I got that. It's just, how do you discern the discounts? What discounts do you apply?
Yeah, good question. So it's all about kind of present value, the present value concept. So $1 today is worth more than $1 tomorrow because of present value. So you've got an inflation component and a risk component that we put into what's known as a discount rate. So if I project that the company is going to have $1 of cash flow in 2014, if I'm trying to present value that back to the very beginning of 2014, I'll apply a discount rate, and that $1, that future $1 is really worth 90 cents or 85 cents right now. And that developing that discount rate is part of the magic or the so-called voodoo of business valuation. It's a fairly difficult concept, but it's all about present value and determining risk. And this capitalized cash, or the capitalized benefits method is really just a very, it's kind of like a one-step discounted future cash flows. We say the average of the last 5 years cash flows was X, so we say that's the best estimate for future cash flows on an annual basis.
You know, you hear about like the rule of thumb, price earnings ratio.
Yeah.
10. You know, I mean that's people can use that for the DCF. You know, if you assume it goes so many years out that take the annual times 10, that's the total by extreme as a rule of thumb. But you know, many companies, I mean, their values swing way above and below.
Absolutely.
That,
Yeah.
I mean, is the PE 10 sort of what it should be if it was just cash flow? But there seems like there's a lot of other factors that drive it.
There's a lot. I mean,
I
price.
mean, above and below that.
Price and earnings and cash flow can be two very different numbers depending on the company, because earnings are going to be accounting earnings. They're not necessarily going to be cash flow. From my perspective, I'm kind of from the school of thought that cash is king, and I like looking at cash as opposed to a paper income number. It's an accounting number, but at the same time, I try and reconcile and get as many different data points as I possibly can. But as far as rules of thumb, they're just they're incredibly varied across different industries. But it's really hard to give any kind of a really good broad rule of thumb for businesses. A couple of really important valuation adjustments to consider. I'm going to go through this real quick. We've got a discount for lack of control and a discount for lack of marketability, also known as a minority interest discount. So if you think about a company, a controlling interest is going to have a lot more value, and a controlling interest is an interest that has greater than 50% ownership. So they're usually going to be able to control voting matters or fill up the board of directors with their picks, basically. So that type of an ownership interest is on a pro rata basis is much more valuable than than an ownership interest of less than 51%. And to account for that discount, or account for that diminution in value, we apply something known as a minority discount. Those can range anywhere from 5 to maybe 25%. Then we also have something known as a marketability discount. So if you think about, say, your 401k or any investments that you have in public companies, if you own stock in AT&T, all you have to do is call your broker, and in three days or so, you're going to have cash in your hands for selling that stock. So if you've got a private company, there's no way you're going to be able to flip your company that quickly, especially if you have a minority interest, a non-controlling interest in that company. Because who among the public is really going to be interested in buying a minority interest in a private company that they're not going to be able to turn around and sell quickly? So these discounts are typically even greater. You're looking at maybe 35, 40% even, depending on the performance of the company. As far as valuation qualifications go, if you end up having to hire a business valuation professional, you really need to look for someone who's not kind of a dabbler in this field. There's a lot of CPAs out there who do kind of a valuation here or there. It's important to work with those that are actually in it kind of on a full-time basis and have some kind of a certification or qualifications. And then I want to touch on patent valuations, and this discussion isn't necessarily limited to patents. It can be any kind of an idea that you have or any kind of a product. But these patent valuations are exceptionally difficult, especially if your process is not yet commercialized and you're not generating any revenues. So again, how do you value an idea that isn't making any money right now? Extremely difficult. Got an idea that is, then it's a much easier task to accomplish. So we use the same general valuation approaches as we would in a business. So you've got your asset approach, your income approach, and your market approach. Market approach is almost never going to work because there's very little data out there for ideas being actually bought and sold, especially, and trying to find an idea that's similar enough to your idea that's been bought or sold is even more difficult. So what we usually end up having to do is we'll try and use an income approach and estimate cash flows again on a going forward basis. Try and use a discounted cash flow model and estimate those future cash flows. So if you've got a track record, or if you've at least got some kind of track record and you're entering a growth phase and you're able to reasonably estimate what those numbers are looking like, then we can get a pretty solid valuation for you. When you've got just pure idea and just nothing more than a wild guess as to what your future revenues are going to be, or if there's even going to be any future revenues and cash flow, then it becomes a much more difficult exercise. But that shouldn't deter you from trying to at least think about that and put a model together. So some of my tips that,
If you're pre-income on a patent, then the asset approach is probably all you really have.
Exactly.
So you're saying, well, what would it take to replace the asset, I guess, right? That's the value.
Exactly. Replacement cost.
Could be as simple as what it costs, right?
Right. And that's why my second little tip on here, or excuse me, my third tip is to gather and really keep track of all that supporting documentation that you have for the costs that you've incurred and the man hours that you've spent developing this idea. So if you've got software, track the number of lines of code and who spent how many hours developing that and what they had to be paid to develop that. But again, it kind of comes down to that that dilemma I mentioned before. Even if you're spending $1 million developing something, if it's an idea that nobody's interested in, is it really worth $1 million? And conversely, if you've spent some de minimis amount of money on an amazing idea that people will be interested in, then that de minimis amount of money that you've spent is not an indication of that value. And that's where you have to go to that income approach and try and estimate how things are going to look in the future. So preparing a really thorough business model and a business plan is really important. I mean, we have people coming to us asking us to value their business with this great idea, but it's all in their head. There's nothing. We don't have any kind of a plan to work with, anything really formalized, and that makes it really difficult for us to conduct evaluation. And at the same time, anybody interested in licensing that product or buying that product it's gonna be a hard sell without having that business plan and that model in place. And the same thing goes with these cash flow projections as well. I mean, I realize that those are very difficult for a brand new idea that hasn't even entered the market yet. But trying to estimate those is really important. And, yeah.
I just thought of a question like, well, the cash flow, of course, is the best. A royalty income from the license agreement, that's a stream.
Mm-hmm.
That, let's say I'm a company, I'm not licensing out, I'm making the product in my patent. So I could say, okay, this product makes a profit stream.
Yep.
That's one approach. Although you might have to say how much of it is due to the patent feature, which can be tricky.
Yes, absolutely.
Would there be another component to that is my patent's deterrent effect from keeping competitors from eating into my
You could,
profits?
you could absolutely think about that.
Okay.
Mm-hmm. And then you also have to think about potential non-infringing alternatives coming onto the market.
Right.
And what those are going to do to eat away at your revenues.
Okay.
Very difficult, hypothetical, but important exercises nonetheless.
Yeah, I know the what is it? The problem in royalty damages is, the base case is you have a patent and a product and sell it, but in the real world, you have a product like this laptop, and it's probably got 500 different patents and bits and pieces of it.
Mm-hmm.
There's patent number 242, and we're trying to assess the value of that patent, which may be a mechanism in the keys or something.
Mm-hmm. And it's like maybe you're trying to deal with the value of the original hard drive may have been patented. Now we've got
Right.
solid state hard drives.
Right.
Well, that's certainly a non-infringing
And
type
it's a
of
part you
alternative.
don't sell by itself. It's
Yeah.
always part of a big assembly.
Yep. Exactly.
I know the latest Twitter and Snapchat IPOs are pretty astronomical.
Right.
How are those evaluated when they don't have any revenue? I know they have
Or low revenue.
large user bases, but is
Right.
that enough to justify, 13 billion and?
I think the market's going to tell us in a couple of years whether those are inflated, but I think a lot of that's just hype. You look at Facebook too, and
Yeah,
companies.
because their PE ratios might be 100.
Yeah, they're
Crazy.
just ridiculous, and it's all based on these astronomical future expectations for profitability and cash flow that are pretty questionable.
But are some of the evaluations hypothetical, like with Twitter? They don't do advertising. They have no revenue at all.
Right.
Is one part of the evaluation saying, well, Twitter could add advertisement, and then that will make increase their IPO? Is
Right.
that something that you guys look at?
That would definitely be something that an analyst would be looking at. And
Okay.
they'd be looking at certainly the number of users. I think that's what it really comes down to. I mean, if there's 100 million or whatever Twitter users.
Well, now if if I was to start a new social media platform, um, would you recommend going in it without advertising up front to get a, just to build user base, or do you think adding advertisement in the beginning to show that there's revenue being generated would be a better approach? I mean, when you're comparing the two, I mean, they're both very distinct, but
Right.
how do they compare in evaluation?
My perspective would be that having that advertising revenue at the beginning would be more helpful.
Well, I mean, helpful on your end, but
Yeah.
on the overall scheme of, which one would get a bigger evaluation number?
I would think that the one that has the current revenue, the current advertising revenue, would have the bigger current valuation.
Okay.
That your user base, potential user base is a big factor.
Yeah, I mean, it's somewhat of a
Well, like
double-edged
when
sword there.
When the underwriters set the IPO price, right, I mean, are they thinking, they got a valuation in mind?
Yeah.
Because you say, okay, I'm selling 1 million shares and I'm gonna price them at $30 a share, right?
Right.
So I'm valuing myself at 30 million or something.
Mm-hmm.
But are they really valuing it or just picking a number that they think works good?
I think it's a little bit of both.
Because it's like, what was the deal with Facebook? It was kind of disastrous, like the number they picked and then it dropped.
Yep.
And then
And
it
it
finally
climbed.
came back, and they don't want that, right? They want it to hit and then climb.
Yeah, they don't want that drop to occur at the
Yeah.
beginning, certainly. Mm-hmm.
I just wondered how that number was come up with. There's probably some traits.
I mean, I've seen people come up with kind of discounted cash flow models for Facebook and say, here's what I think that revenue stream is going to look like for the next 10 years. And here's the discount rate that they think should be used. But trying to estimate where Facebook's going to be in 10 years is just
that's
incredibly
too
difficult.
uncertain, Yeah.
Is it possible to get a different number from, like if I had you evaluate Facebook and then I had another CPA evaluate Facebook,
yeah.
is it possible that you guys would come up with different numbers, or is the system the same?
If we didn't come up with different numbers, I'd be shocked.
Okay.
There's a lot of professional judgment that comes into this.
Okay.
Mm-hmm.
So a lot of it comes down to getting a second and third opinion until you hit a number that you want.
You keep getting valuations till you get the right number.
I mean, for the public companies, I don't know how many they get for determining their IPO price, but the thing is, most evaluation work that I do is it's in the realm of private companies where we never really know if our answer is our professional opinion,
Mm-hmm.
and the only way to really get that affirmed is to have a transaction actually occur at that price or at that value that we come up with. Yeah, good question. Anything else?
So how much of your evaluation is formality and like by the book, and how much is it just your professional opinion on and your personal experience with the company?
It depends on the valuation, but a lot of it comes back to that discount rate issue that we were talking about before. So that discount rate is very there's a very big scientific component to that, and there's also a judgmental component to that. So we know, for example, the returns on the stock market over the last X amount of years. So we know that equities that public equity generally earns about 5.5% more than government bonds. And government bonds typically earn, let's say, 4%. So we know that
equities
over time earn 9.5%. And we know that smaller company equities, the smallest public companies, have returns that are about 6% greater than that. So the smallest public companies earn about 16-ish% on an annual basis. But then we look at a private company, and a private company has a lot more risk than a public company. So we have additional amounts that we add to quantify that expected rate of return. But there's no definitive right answer for how much to add. So is it 5%? Is it 8%? Is it 10%? We know we've got a pretty good range to work with, but saying it's 5% or 6% or 7% is literally impossible. So every appraiser is going to have a different opinion on that, and that's one reason why we're going to have different answers on
Okay.
value.
One other thing that you said in the presentation, a key component is when you do the evaluation. Is there, I know as the business grows, the evaluation's going to change.
Yes.
But is there a good revenue number that you give out to say, okay, when you hit 100,000 or 250,000, okay, you know, you should get evaluated?
I don't have a real rule of thumb on that at all. I don't encourage people to get evaluation for no reason. I mean, there's got to be a rationale behind it. So it's got to be either you're trying to raise more money through getting additional investors, or somebody's leaving the company, your partner's leaving, and you need to pay him out. So it's all kind of facts and circumstances as far as that goes. But yeah, so there's no real rule of thumb when it's time for evaluation.
Okay.
Anything else?
So you guys have 640 offices worldwide?
Our international association does. Yep.
You do general corporate taxes and
Absolutely.
are you the rainmaker? Are you out running that business?
Oh, I try. That's part of my role. I'm a little bit more on the technical side of things, though, where I kind of get up to my elbows and doing a lot of the actual technical valuation work itself. So, but that's kind of the way it works for a lot of us as CPAs. We have to bring in the business and service the clients. So thanks for your attention and really good questions. Appreciate you being allowed to speak tonight.
No, we got your number here. Do you have a card?
They are inserted.